Welcome to the Allan Small Financial Show. Thank you, as always, for taking the time out of your busy day to spend it with us. We have another great show for you this afternoon, and what we try to do on a regular basis is bring in very special guests to talk to us about different parts of the economy, what's going on with the consumer, what's going on with the average investor. Today, we have a great guest, Doug Hoyes, who is a licensed insolvency trustee. He'll be speaking to us about this idea of businesses and consumers, unfortunately, as of late, not being able to cover their costs, to cover the interest payments on some of their debt. So he's going to shed some light on this topic that we've been hearing more and more about over the last few weeks. So Doug, again, another one and a long list of great guests that we've had, whether it was guests in the area of politics or technology or banking. We try to bring guests to every show if we can, sometimes not, but we try to bring guests as many times as we can into the show to talk to all of you about a certain topic that many of you are asking about. We can put up the list. Yep, there it is for this week. We're also going to, this week's show or today's show, we're going to be speaking, as always, about the top 3 things to consider over the next 10 business days before you make your investment decisions. The U.S. economy is strong. We're going to talk about just how strong the U.S. economy is and why this is affecting the stock market, but maybe not in a positive way. You know, good news is sometimes bad news, as we've said on the show. And so we're going to touch on that a little bit in that segment. Understanding why an investment goes up or down. This is crucial before anyone makes a decision on an investment that they own or perhaps an investment that they want to buy. And if that investment either spikes up or goes down, I think it's important to understand why that investment is going up or down. And sometimes, as we're going to discuss, it has nothing to do with the actual investment itself. It could be the macro data or what's going on in the world today that affects that particular investment. Why investors gravitate to dividend-paying stocks? I think that's perhaps an obvious question. We know Meta, formerly Facebook, they issued or announced a dividend that they would begin to pay at their latest quarterly announcements, I guess a few weeks ago now. Stock shot up 20% in one day, the biggest increase of any stock. We've said it on the show before, biggest increase of any stock price ever in history. And a lot of it had to do with them talking about issuing a dividend and a buyback. And so why are dividends so important? And lastly, we're going to take some of your questions, some of the questions that you have during the show. If you have a question with respect to what our guest is saying, please enter it into the chat boxes. If you have any questions regarding what I'm saying, I'd love to take your questions at the end of the show. And if I don't get to them at the end of this show, then I'd be more than happy to either answer them over the next couple of weeks leading up to our next show or even on our next show. So if anyone has any questions, please do not hesitate to send them to us. And we would love to have them and to answer them. So without further ado, let's get on with the show and our guest. So I'd like to welcome to the show Doug Hoyes of Hoyes, McCallus and Associates, a licensed insolvency trustee. Doug tends to focus on helping individual people rather than corporations to rebuild their financial future. In addition to helping Canadians, he has appeared as an industry expert before the Senate Banking, Trade, and Commerce Committee and serves as an OSB, Office of the Superintendent of Bankruptcy, Oral Board Examiner. He also is an author and is interviewed very frequently by key media about insolvencies. I'd like to welcome to the show this afternoon, Doug Hoyes. Thanks for being here, Doug.
Thanks very much.
Excellent, excellent. I thought we'd have start off with a general question. I think it's a question on the minds of investors. I get it all the time, and it's about the consumer themselves. And I guess what we're seeing now, and it's interesting pattern. You know, once upon a time, you know, we wouldn't spend if we didn't have the money. And I think over the last, I guess now, decade or even longer, we're noticing that individuals, even though they may not have the money to spend, they're doing so quite frequently. At one point, I think We were spending $1.60 for every dollar we made on average in Canada. The last number I saw recently was up to $1.85 for every dollar that we make. And so I guess my first question to you is, how long can the consumer continue to spend if they're just not making the money? How long can they use the plastic, use the Visa cards? Are we starting to see cracks in consumer spending?
I think we are. And if you had asked me that question 5 years ago, I would have said, I don't know, maybe another year. And here we are. How far can you blow up the balloon? I don't know. We'll know when it pops, I guess. I think what's happening now is more and more people are hitting that limit. So you can see it in the number of personal insolvencies filed. As you said, the debt levels have certainly gone up. It's not just the debt level, though. It's the ability to service that debt. So 2 years ago, when interest rates were really low, wasn't so big a deal. I could have $1 million mortgage if it's a 2% mortgage rate, no big deal. But now that rates are a lot higher, we are getting a lot closer to the wall. So I think the answer to your question is more and more people are hitting the wall every day.
And so you mentioned businesses and consumer. Obviously, there are business insolvencies, consumer insolvencies. We've seen business insolvencies in 2023 spike 41.5%. I believe, if I'm not mistaken, that's a 3-decade high. We haven't seen that kind of number in a long time. Consumer insolvencies were up 23%. Why do you think there was such a dramatic spike last year among businesses, amongst consumers? Is it just I guess the idea or the notion that interest rates are higher, people with mortgages are carrying obviously a larger debt, and so with interest rates rising, these people are struggling? Is that the main reason why we've seen such a spike, especially on the consumer side?
It is, but we're also going off a lower base, right? So during, 2020, 2021, the number of insolvencies went way down because, hey, I'm not working. Nobody can sue me. They can't garnish my wages, so I don't have to file a bankruptcy or a consumer proposal to alleviate that. So when you're starting from a low number, any increase looks big. If you look at December 2023, which is the most recent personal insolvency stats we have, it's still slightly lower than the number of filings in December of 2019. So we are not yet back in Ontario anyways until that to that pre-pandemic level. Now, the businesses are even more interesting because you're right, there was a 41% increase in business insolvencies last year, but the total number of business insolvencies in Canada was something like 4,000, 5,000 insolvencies. So it's not a massive number when you compare it to the well over 100,000 insolvencies for people. But what concerns me is most businesses that cease to exist don't go bankrupt. They just go out of business. So you think of a hair salon, a barber shop, a restaurant. The shutdown happened. They were shut down for many months, and then business resumed. But a lot of them, you didn't go back and get 9 haircuts the day your barber reopened. They've lost that permanent amount of revenue. And they've got a bunch of debt. A lot of them have FEB loans, for example, but they don't file bankruptcy. They just shut their doors and say to the landlord, look, here's the keys. You can do what you want. And the landlord says, oh, well, if you've personally guaranteed this, I might come after you. Yeah, maybe you will, maybe you won't. I guess I'll deal with that then. So when you look at FEB loans, for example, there were about 50 billion of them given out to almost 900,000 businesses. And I don't have accurate stats on this, so I'm just going to make stuff up here, Allan, because that's kind of what I do. But my understanding is that something like 25% of them have not been repaid, which means that's a big number. We're talking, obviously, hundreds of thousands. Let's say a couple of 100,000 businesses haven't repaid them. And let's say that maybe only 10% of those businesses over the next year or two decide to file an insolvency. Well, that would be 20,000 filings. There were only 5,000 last year. So FEB loans alone, even if it's just a small percentage, could cause a massive spike in business insolvencies. Be very interesting to see what happens over the next year or two. But there's a lag effect. It doesn't happen immediately. The FEB loan repayment deadline was January 18th. We're only just over a month from that deadline. It's going to take many months, maybe even a year or two before the full impacts are felt.
Interesting. You mentioned FEB loans. I was actually going to ask you about that because I was just going to, I guess, ask you about identifiable trends, right? Are you seeing any identifiable trends that are causing these insolvencies like FEB loan repayment? Is there things that, you could point to and say, hey, that's happening. Okay, this is what's going to lead to a rise in insolvencies.
Well, I can tell you that prior to January 18th, I got a lot of phone calls from people saying, hey, I'm not going to be able to pay back my SIBA loan. What can I do? And for the last year or two, I've been getting a lot of phone calls from individuals saying, hey, I got the CERB during the pandemic period, and now the government's saying I wasn't eligible. I've got to pay some of it back or all of it back. So all of those are the people who are calling me now. But a lot of those people are not filing insolvency yet because the government is just at the point where they're sending them a letter. They're not taking any aggressive collection action. So the can has been kicked down the road for a considerable period of time, I think. As to what we're seeing, though, we're seeing, everybody's getting into trouble. I talk to laborers, which is kind of what you'd expect, but I also speak to probably one doctor a month who's in financial difficulty. So it's all over the map. And the problem's really simple. Expenses have gone up faster than incomes. So what do you do to bridge the gap? You use debt. And so long as that continues, we're going to continue to see continued increases in insolvencies.
Have you noticed a broader range of Canadian consumers running into insolvency issues? Meaning, are you noticing that perhaps older people are declaring or filing for insolvency versus the younger generation? Are you seeing it more with the older population, or is it a younger population thing, or is it kind of everybody, like you said, is right now in a bit of a pickle?
Well, it's kind of everybody. I mean, the boomers are kind of aging out of it. So they're now at retirement age. Oh, well, I'm not working, so I guess they can't garnish my wages, so I don't have to worry about it. We're seeing a lot more millennials, of course, because they're becoming one of the biggest cohorts and one of the biggest cohorts that's working. But what we're also seeing is people of higher incomes who are filing insolvency. So that doesn't mean they're earning more money because wages aren't going up as fast as expenses. What it means is someone who didn't have to file insolvency last year at that same pay level is now filing insolvency. They're moving up the curve. So during the pandemic years, well, maybe it was somebody who'd lost their job, they weren't working. Now the vast majority of my clients are working. Well over 85% of my clients are employed at the time they file. They're just not making enough money to make ends meet. So the big trend we're seeing is that people of higher incomes are filing insolvency. And I don't have stats to back this up, but I think it's also people of higher credit scores are getting into trouble too. They were able to borrow, their credit score looks good, but they just can't make the payments. So that's definitely a trend we're seeing. People are moving up the income curve with respect to filing insolvency.
I guess it makes sense because you get used to a certain lifestyle, right? When money's easy and free flowing and interest rates are basically zero, and you have access to really whatever capital that you need, you get used to to living a certain lifestyle if you're a consumer or a business, in terms of growing the business. And I guess once things start to turn around, and I guess the Bank of Canada and the Federal Reserve in the U.S. they gave us all the indications that this was going to happen. Yet it's very difficult for people then to scale back, right? You get used to a certain way of living, borrowing without even thinking at times. And I guess it just shows that even people that have money, have jobs, they get caught by the same things as those that may not.
Yeah, and I think if you go back 2 or 3 years, the Bank of Canada was saying, well, we're not going to raise, or we are going to. I mean, they did the exact opposite of what they were saying. So yes, they have telegraphed it, but they don't telegraph it precisely. And yes, you're right. The definition of debt is I spent more than I brought in. That's what debt is. Totally agree. But it's not as simple as saying, oh, well, people have lived beyond their means. That kind of sounds deliberate, like, well, I'm taking 4 vacations a year and that's why I've got a bunch of debt. Sure, there are some people in that case, but the vast majority of people I'm dealing with are going to the grocery store and finding that the things they pay for, food, is a lot higher than it was a year or two ago. And yeah, I know the inflation rate is lower than it was. That doesn't mean prices are down. It just means they're not going up as fast. We had 6 months last year where the CPI was 10% or higher. I don't know of too many people whose wages went up 10% during that 6 month period. So yeah, you're right. I'm used to eating food every day. And as a result, that's what my lifestyle accommodates. But as the costs go up, and my income doesn't go up at the same speed, I'm pinched. And that's absolutely what we're seeing. And I think everybody knows that. We all know things are more expensive. If you've got a great job and are making good money, and if you were invested in real estate or the stock market or something, and as a result, your wealth went up, you're okay. But the people who were not owners, who didn't own a house, who didn't have investments, those are the ones who really got hammered because their expenses went up faster than their income and they didn't have any assets to fall back on.
So I'm going to ask you to dust off that crystal ball and ask you, do insolvencies, the situation get worse in 2024? What do you think?
Yes. I mean, the trend is pretty well established, and on a week to week basis, I mean, I see the numbers every day, and okay, the first week of February wasn't that busy because the sun was shining, the weather was good here in Ontario, and people were out doing things. But in the last few days, when the weather has turned, it's gotten a lot busier for us. I would expect that we are going to see an increase in personal insolvencies of somewhere in the range of 25 to 30% this year. And that will put us certainly above the pre-pandemic levels. So we will, start to be setting multi-year records again. I don't see any way that that trend doesn't reverse. I mean, you look at credit card debt, it's way higher than it was pre-pandemic. So unless we see a massive drop in interest rates tomorrow, which I don't think is going to happen, and a massive increase, I don't know, in the real estate market so that everyone can borrow and pay off their credit cards, I think it's baked in the cake. We will see higher personal insolvencies throughout 2024 and probably into 2025 as well.
Wow, it's yeah, definitely it seems to be going that direction. And so I guess for my last question, trying to leave off on a maybe something on a positive or just some information to impart to those that are watching. I guess my question is, what should businesses and consumers do when they see signs of trouble? Do people often wait too long before they actually, do some sort of intervention? What could people do to mitigate what is happening? Their costs are rising, their incomes are not rising at the same level. At what point should they then say, wait a minute, we got to stop what we're doing? And what advice could you give individuals to kind of say, hey, you're going down the wrong path. We need to make a change here.
Well, debt does not get better on its own. Compounding interest, if you've got assets, it goes, it's great, but it goes the other way. You can get into a hole really quickly. So don't wait. It's exactly like with a medical problem. If you've got a medical problem, probably waiting 6 months is not going to make it better. It's going to make it worse. So if you are experiencing debt problems, if you're a business, obviously reach out to your accountant, your lawyer. Maybe there's some cash flow things you can do and so on. And if you're a person feeling that same pinch, then the person you want to talk to is a licensed insolvency trustee. We're all licensed by the federal government. You don't want to follow some guy on Facebook who just put up a page yesterday and says he can settle your debts for 20 cents on the dollar. And no, you want to deal with a reputable professional. There's no cost to meet with us up front. So the sooner you talk to a professional and understand your options, the more likely you are to be able to come up with a plan and get a fresh start.
Well, great advice, Doug Hoyes, licensed insolvency trustee. Thank you so much for being with us this afternoon, giving us some great information, great tips at the end there for those that might be going down that path, unfortunately. Once again, thank you so much for coming on the show.
Thanks, Allan.
All the best. Talk to you soon. Bye-bye. Now we come to the part of the show where I talk about what individuals should be considering before they make their investment decisions over the next 5 to 10 business days. We usually have 3 topics in mind, and 3 topics are on the screen right now. I want individual investors to consider the economic data. We had some economic data recently, CPI out of the US. We had inflation numbers out of Canada, Canadian inflation dropping down to 2.9%, a fantastic number. It's the first time we've seen a number with a 2 in front of it in quite a long time. But we're also looking ahead for some economic data, and we'll talk a bit about that. Quarterly earnings. We have a big company, probably one of the biggest, definitely one of the biggest in the world today, reporting earnings after the bell tonight. NVIDIA reports earnings, a big company that will have major effects on the stock market, and also Canadian bank stocks. Canadian bank earnings will be reported next week, the end of next week. So quarterly earnings, I think something to consider as an investor, and how investments can affect your investing goals. Whatever you choose as an investment, it can affect and should affect your investment goals and reaching those goals and obtaining those objectives. So we're going to talk a bit about that as well. So let's get on with the first one, economic data. As I mentioned, we've had some CPI or inflation data reported already out of Canada and the US. But in particular, coming up, we're going to get a second reading of GDP out of the US. So they came to us with their first GDP number. Now they get a revised number that could revise that number up or down a little bit. We're going to get Canadian GDP coming out as well. We're also going to get or receive PCE. It's a number that PCE stands for personal consumption and expenditures. This is something that the Federal Reserve really looks at closely to get a feel for what investors and consumers are spending, what they're consuming, what their expenditures. And that goes a long way to figure out what's happening with respect to inflation. We're going to get the PCE data next week as well. So a lot of economic data coming out in the next week or so. And I think individual investors need to focus on this because with that inflationary data or with that economic data, markets will move, interest rates will move. And as we know, if interest rates go up or down, it definitely affects the markets. We have our first chart here on U.S. personal consumption expenditures, PCE, on an annual change basis here. And you can see how the PCE number has dropped significantly over the past, let's call it, year and a bit. And that is crucial. That is very good. That's what the Fed wants to see. We also have a second chart here on U.S. GDP. And again, you're going to see that fourth quarter looks like in and around 3.3%. Last quarter of last year, 4.9%, almost a 5% number. And you can see how GDP has definitely popped in the last, I guess, few months. And so again, showing us that the U.S. economy is quite strong. And we'll see if that GDP number is revised, I guess, in the next week or so. I always like to show the Canadian number because obviously I live in Canada and this is a show done out of Canada. But keep in mind, markets tend to move more with what happens out of the US than actually our own economic data here in Canada. So this, you can clearly see how our GDP growth rate, well, I guess it's a non-growth rate or a negative growth rate is happening. You can see how much it's tailed off in the last few months as well. So overall, I guess economic data to me is something, the macro picture is something that I need individual investors to focus on because it's going to affect interest rates. And as we know, interest rates definitely affect the stock market. The second topic or idea that I want individual investors to consider before you make your investment decisions are quarterly earnings. And as I mentioned, we're going to get the biggest one tonight. And I say the biggest one, even though NVIDIA is not the largest company in the world, although I will say NVIDIA actually passed just in the last couple of weeks Amazon and Alphabet, formerly Google, to become the third largest company in the world today, approaching $2 trillion, only behind Microsoft and Apple, which are well above $2 trillion. Now, as you can see, we'll show a graph on NVIDIA. You can see that NVIDIA has fallen on a bit of hard times in the last day or so. You're seeing about maybe a 6% decline in the shares. So perhaps they've pulled back just below the market cap of Amazon and a Google. So, but nonetheless, you're looking at the largest chip maker in the world and what many can consider the most important name for artificial intelligence. We know NVIDIA supplies the chips mainly for artificial intelligence. And at least for now, AMD and Intel and Marvell and some of the other names, they're just not anywhere close to what NVIDIA is doing with respect to the AI world. And because of that, NVIDIA, a name like NVIDIA, their margins are just huge, 75% margin on their products. People are paying a lot of money for their chips, and these chips are being purchased regularly. So Why is this name so important for the stock market? Because it is the most important name right now in artificial intelligence, technology, and we know that that is the one area that has been driving this market higher. So if we get a disappointing number tonight and the bar has been set pretty high, you could see possibly a sell-off in the overall S&P 500 and stock market. And some actually are saying you could see maybe a 5 to 10% sell-off. I don't know if we'll see that big of a sell-off if numbers are not good, but definitely it will affect the markets. We also have a couple of charts here on some bank stocks. And as I mentioned, Canadian banks will start to report earnings the end of next week. And again, important for individual investors to consider because living in Canada, many investors will own bank stocks, either one or two of them on individual basis. They'll be owned through a mutual fund, an ETF. In some way, most Canadian investors own Canadian bank stocks. And I've always, or I shouldn't say always, but most of the time, we've spoken on this show about Scotiabank. And there's a chart on Scotia. Starting to see Scotiabank stock ride a little bit higher. Their dividend is in that 6.6, 6.7% range. So very enticing for individual investors. And the second bank stock I wanted to highlight was TD Bank. TD Bank, arguably second largest bank in Canada. Some would say at one point it was actually the largest, passing Royal Bank. But here you can see their stock has gone down recently. They're paying about just over a 5% dividend. So these banks, great to own for not only potential growth, but also the income that they produce. And because so many own these bank stocks, it's a very important, piece of information for individual investors to consider before they make their investment decisions. The third point I wanted to discuss today for investors is this idea of buying individual investments and understanding that it's definitely going to affect your goals and objectives. I talk to obviously a lot of people on a regular basis, and everyone wants the same thing. They want to grow their wealth with the least amount of risk as possible. We all want that. However, it's hard to get growth in a portfolio or grow your wealth when you want a low risk investment. Low risk investments, predominantly, in my opinion, are places to just park your money and earn a small rate of return. And so if you come to me or an investment advisor in general and say, I want to buy GICs or bonds, but I'm looking for 7, 8, 10% growth, well, those don't match. And if you were to buy a low risk interest paying investment, it's going to bring down the average growth in your portfolio. And so it will affect how quickly you reach your goals, your investment objectives for your investments. And we have a couple of charts here. One of them, for example, is the real return of a GIC. And we've had this chart up before. We've seen, unfortunately, and you can see here the gold line, and tough to read the writing there, but I can tell you the gold line represents the rate of return. Once you factor in inflation and taxes, you could see that the rate of return of a GIC most of the time is not even zero. It's actually less. You're actually losing money after you pay taxes and after inflation is subtracted. So if you were someone that wanted to grow your portfolio and wanted to own GICs, well, unfortunately, those two things in many instances just don't jive. And if you're going to own bonds or money market funds and things of that nature, we know those things today are paying close to 5%. But after you factor in a 3% inflation rate and taxes, probably not making a lot of money, and it's difficult to grow your portfolio, and it'll affect your investment objectives. Another chart I have here, I actually have a chart of two stocks in particular. First one is Bell Canada, BCE, a name, again, that Canadians own in many portfolios. But again, if you're looking for growth, is this a name you're going to want to own? Probably not. It pays a pretty good dividend today, 7.8% dividend, highest I've seen on BCE in a long time, but the stock is struggling. You definitely would have lost a lot more capital loss than a 7.8% dividend could cover. So meaning the losses are greater than 7.8%. So this is a name again. If you're owning it for growth, you're probably in the wrong place. Another name similar to BCE in a similar chart is Enbridge. Enbridge is a name, once again, that here's the chart. We've seen a little bit of a turn up and now back down again, also paying 7.8%. But this is a name that you're going to want to own for income. BCE, that you would own for income as well, although I will say a lot of individuals believe that BCE could cut that dividend, something we haven't seen from BCE in many, many years. Enbridge seems to be increasing their dividend on a regular basis. So to me, that dividend, keeping that dividend intact makes a lot of sense. So overall, you've got to look at what you want to accomplish. What are your goals and objectives for your money before you choose the appropriate investment? And for this segment, I'll end on a great chart. So someone who is looking for growth, you're going to want to own a name like Microsoft. And we have a chart of Microsoft here. Microsoft pays basically no dividends. I think it's like less than 1% dividend. But look at that chart. If you own Microsoft over the last few years, you would have made quite a bit of money. Your portfolio would have grown. That stock has grown. So understanding what you're buying, understanding what you want that money to do for you, and putting those two things together is very important to understand before you make your investment decisions. Because if you're looking for growth and you're investing in the wrong areas, either income generating or ideas that aren't growing, then it's going to affect the outcome of that portfolio and perhaps delay your investment objectives or getting to or reaching your goals and objectives. So keep in mind that going forward, you want to own the right things at the right times and obviously at the right price. And to me, that is always the best recipe for success. The U.S. economy is strong. There's no doubt about that. We continue to see unemployment 3.7%, basically at all-time low points. It was once upon a time a little lower than that. It's crept up a bit, but still 3.7%. We've seen job growth well over 300,000. I think it was 353,000 to be exact. And that was for the month of January. Month of December showed strong jobs growth as well. Productivity for the fourth quarter up to 3.2%. Again, very strong data. The retail sales, although the recent numbers have shown a bit of a pullback in retail sales, consumers continues to spend. Saw an interview with CEO of Bank of America recently this morning, and they talked about how the consumer is still strong. And when people are working, they have jobs, they're making money, then they're spending that money and they're able to continue to drive this economy, the U.S. economy, that is a lot higher. Our economy here in our country, Canada, not doing as well. GDP for last year predicted more in the 1% range. The last few months, we're seeing actually, as we'll see shortly on a chart, a negative number. So we're kind of just skirting by here in Canada, flatlining, but the U.S. is extremely, extremely strong. And that is probably the main reason why we're seeing inflation stay stubbornly high. We were expecting inflation in the U.S. to drop to 2.9%. It dropped from 3.4 to 3.1, but still not where we expected. And because of that disappointment, stock market fell quite substantially the day that that data was released. First chart I have here to show all of you, monthly job creation in the U.S., and there you have it. 353,000 jobs created for the month of January, much higher than what was expected. I think we were expecting below 200,000. So well above what was expected. You can see right beside it, December job creation was almost as high. And if you go back, you'd have to go back to beginning of 2023 before to see a number like that on a monthly basis. The next chart, U.S. Consumer Price Index. You can see that, yes, the inflation rate, 3.1%, 3.9 on core, which takes out volatile food and energy prices. And that was flat month over month, 3.9%, didn't move. We moved on the headline 3.4 to 3.1. You can see here, even though it's down a little bit, it's kind of flatlined in the last few readings, last few months. So something that the Federal Reserve is watching for. And again, one of the main reasons why they're being hesitant with respect to cutting interest rates. Not sure they want to cut so quickly. When you look at the next chart that we have here, you can see U.S. Canada GDP. It's a chart showing GDP growth as compared to other advanced economies. And you can see here that for 2023, the United States was tops, followed right behind by Spain. Predictions for 2024 looks like Canada looks to come in a little bit higher, 1.4%. United States to drop a little bit, closer to 2.1. Perhaps that lag effect on higher interest rates will kick in a little bit more this year and slow things down a little bit more. And you can see in 2025, Canada is expected to go up to almost 2.5%. And again, United States now below 2. So perhaps in 2025, Canada will grow GDP, or will have better growth than the United States. So, overall, I think it's important to look at, the U.S. Their strength is very important for us here in our country because they are the largest trading partner for us. We send about 70% of what we take out of the ground and build to the United States. So if their growth is strong, if they're growing at a 3-4% clip, and if that can be maintained, eventually this will spill over to us, and we will show some growth as well. Understanding why an investment goes up or down seems simple enough, but I can't tell you how many times I get approached by investors and they say, such and such stock went down. I don't know if it's a good idea to buy it anymore. It's fallen very quickly. And I turn around and I say to them, but do you understand why that stock went down? And it actually had nothing to do with the actual company itself. It had to do with a crisis somewhere in the world, or it had to do with perhaps interest rates moving higher, or the Federal Reserve saying something that the market didn't like, something that had nothing to do with that investment itself, and that investment falls in sympathy. And we know we've been through this many times before. We've seen crises before. We've seen the overall market fall, only to come back stronger and better for years to come after the crises. So understanding why an investment goes down, probably more important than understanding why it goes up, because when an investment goes up, many people say, hey, I don't care why it went up. I made money. That's all I care about. But really understanding why something goes higher is important as well. You want to know, was it because it went up in sympathy with good earnings from another company in the same sector or category? Or did it go up based on its own merit? Is a stock going up because interest rates are falling and that's good for the overall stock market? And vice versa. Is it an investment going down because interest rates are going back higher? Because the Federal Reserve is saying they're not going to cut interest rates to the second half of this year. Maybe we'll see 1 or 2 cuts only when the market was expecting 4 or 5. So understanding why an investment goes up or down is extremely important. And I think my favorite chart of this show is a chart here, the history of recoveries. I think it's important for individual investors to see, and I'll read out some of them here. So underneath it has a bunch of crises. It has, for example, recession, 1980. You could see that overall, it looks like market was down 27%. And then over the next 1, 5, and 10-year number, so the 1 is the blue, the 5 is the green, and the 10-year is the purple, you could see the big bounce back in those numbers. 1987, the one-day crash in October 1987, market dropped 33%, looks like. And then once again, you could see a sharp rise. And the 10-year looks like, with the exception of the Great Depression, the 10-year number, after all these crises, so that's the purple column there, is well above what happened, I guess, 10 years prior. So what does that tell us? Well, it tells us that over the long term, and even over the short term, because most of the one-year numbers are significantly higher as well, the market bounces back. Individual investors look for these opportunities where the market can and will bounce back after a crisis. The second chart I have for this segment is just a simple chart on CIBC. And I show this because Someone will say to me, Allan, why did my CIBC stock go down? It's got nothing to do with the United States or international markets. Most of its business is in Canada, although it has expanded a little bit in the United States recently over the last few years. But why is CIBC stock going down? And quick answer is today, the way the markets work, not only can you just own CIBC stock on its own, but you can also own it in a managed product, an ETF, a mutual fund. And so what investors do when they need to sell something is they don't sell what they need to sell. They sell what they can sell. And so if you own a mutual fund or an ETF, it's an easy thing to sell. You're up on the name. You need to generate some money to cover a margin call or something. Market's going down. You're getting nervous. You sell the ETF. And by coincidence, maybe CIBC stock is in that ETF. Maybe CIBC stock is one of the names out of 50 names in a mutual fund. And so when you sell a managed product, unfortunately, you're also selling the names that make up that product. And so CIBC falls in sympathy. So again, understanding why an investment goes up or down is crucial before you make an investment decision. And don't always look at it as, oh my goodness, it's gone down 5%. Is that a name? It's looking a little, sketchy right now. Understand why it's down 5%. It may be a great buy opportunity for the future. So why do individual investors gravitate to dividend stocks or dividend-paying investment ideas? I guess simply put, dividends can help grow a portfolio. It could add to the growth. So if you have an investment that's gone up by 5% and the dividend is another 5%, well, there you have 10% growth. It can also cushion an investment if things were to go the other way, if that investment were to go down. If an investment drops by 5%, the price of that investment drops by 5%, but that investment is paying a 5% dividend, well, that investment pretty much is at break even for the year. So it can cushion you when times are tough and can enhance returns when times are fantastic. And as I always say, good recipe for success is to buy something that not only can grow, but also pays a good dividend. Because while you wait for the growth to happen, and sometimes it doesn't happen right away, you're getting paid something while you wait. And as I said earlier, a name like Enbridge paying over 7%, more for the income than the growth, however. But there are other names that can pay you both. And we have a nice pie chart here, which shows the different sectors of the market. We'll show it there. There it is. And you can see that these individual sectors, these are sectors that have had names in it that have grown their dividends for 25 plus consecutive years. And you can see here, the biggest piece of the pie are industrials. 24% have grown their dividend for 25 plus years consecutively. Another one you could probably guess would be consumer staples. You don't really buy again. Consumer staples tend to move a lot slower for growth than, let's say, a technology sector would, but they pay good dividends and they grow those dividends over time. Financials, there you have it, 11%. Materials, 12.5%. Healthcare, 10.5%, rounding out the largest sectors of that pie chart. So overall, it's dividends can continue to enhance an investor's returns. You want to be in these names for growth, for income. I think it makes a lot of sense. Great recipe for success. And I guess the last chart that we have here is a bar chart. And we have new dividend payers among the S&P 500 by year. And you can see here how much we have grown recently. Obviously, 2024 just started, but 2023, 2021, how many individual companies started paying dividends? I guess they had a lot of cash on the books. Things were closed down. They didn't know what to do with that cash, so they returned it to the investor. And as I said earlier, a name like Meta just started a dividend, $50 billion buyback, really got individual investors excited. Now, not only are they going to have a bit of a dividend, not a huge one, but a small percentage, but that also tells them that the company is strong and cash flow is great. And that's with any company, not just Meta. So you want to look for good quality dividend payers, those companies that can continue to pay their dividends and increase their dividends over time. And I think those are most important. Rather than find the company that's paying the highest dividend, you want to find the company that can maintain that dividend and grow over time versus just look for the highest dividend payer. Now the part of the show where I take many questions as I can, and as always, when we have a guest, we always seem to run out of time at the end. But I know Doug Hoy's great guest, gave us some great information. So it's great to hear another person's point of view on certain topics. So I think we have a few questions here, and I guess just have time, I think, to take one of them right now. Looks like the first one on the list here. We have a couple on the list today. How often should I be meeting with my financial advisor to review my portfolio? And I think it's a question that a lot of investors ask, really. I would say a question that I get when I take on a new investor, and they tell me, how many times do we meet a year, or how many times do we talk by phone or discuss things? And I think I guess my answer to that question is it's up to the investor. I have clients who I meet and talk to, a few times a year, and I have clients who I talk to, once every few weeks, once a month. And it just depends on the investor and how active they are, how active they want to be, how often they have questions to be answered. So I think it's just really there is no magic, magic number. I always tell my clients I like to be in touch with them on a regular basis, every 6-8 weeks. If nothing is happening of significance, if something happens, something crucial happens, something of significance quicker than that, I'll be on the phone to investors regarding that matter as quickly as I can. So how many times you talk to your investment advisor really, I think, is up to each individual investor. So with that, I want to say thank you again to our guest, Doug Hoyes, for being on the show this week. I also want to thank all of you for tuning in and taking some time out of your busy day. I also want to say that catch our next episode 2 weeks from today, which is March 6th at 12 noon. And as always, we'll be here to answer your questions and talk to the hot topics of the day, the week, and the last couple of weeks, actually, hot topics that have come up. So until then, I want to wish everybody happy investing.